Why it's so hard to figure out the economy right now. The U.S. economy is increasingly K-shaped, meaning it benefits higher income earners while leaving lower income Americans behind. Top of the K, wealthy individuals see strong 401k growth, rising paychecks, and can afford discretionary spending. They help keep overall economic indicators looking positive. Bottom of the K, lower income workers face persistent inflation, rising costs for necessities, debt challenges, and minimal gains in real wages. Their struggles reflect the broader dissatisfaction captured in polling data. The divide has worsened due to loss of guaranteed pensions, gig economy growth, healthcare and housing costs, and college expenses. Temporary gains for lower-income Americans followed pandemic-era stimulus and low mortgage rates, but these effects have faded. Recent data shows real pay for non-managerial workers fell 0.1% from August to September, while higher-paid workers continued to see gains. Even middle-income consumers are beginning to tighten spending, as seen in Walmart's fastest-growing customer segment being households earning over $100,000. Overall, the K-shaped economy highlights a widening wealth gap, with upper earners prospering and lower earners struggling, despite record-level stock markets. This segment clarifies the difference between affordability and inequality, and examines Trump-era tariffs' impact on consumer costs. Affordability versus inequality. Inequality measures the wealth gap, who earns more versus less. Affordability reflects whether everyday goods and services fit within a household's budget. Example, a $230 designer iPhone sock sells out, affordable for high earners, but a $12 Chipotle burrito is a struggle for those making $100,000 or less. Impact of Trump policies. Broad inflation remains moderate, 3% annually, but some tariffs have raised prices on imported goods like furniture, plus 6%, Swiss watches, plus 6.6%, bananas, plus 7%, and coffee, plus 19%. Average American household may pay $1,200 more this year due to tariffs, though tax cuts partially offset costs for higher-income households. Currently, businesses are absorbing 80% of tariff costs, but J.P. Morgan economists expect consumers could shoulder most of the burden next year, $1,600 per household. Key insight: affordability pressures hit everyday life and spending choices for middle and lower-income households, even if broader economic indicators appear strong. This section discusses housing challenges and U.S. government stakes in private companies under Trump 2.0. Housing issues. Trump's proposals, like 50-year mortgages, portable or assumable mortgages, are considered impractical and potentially destabilizing. The real problem is a long-term housing shortage caused by underbuilding since the 2008 financial crisis. Federal solutions are limited. State and local governments are experimenting with zoning reforms and reducing red tape. NIMBYism, not in my backyard, and location constraints, example access to public transport, complicate solutions. U.S. government investing in companies. The Trump administration has taken stakes in private firms like Intel, aiming to maintain U.S. competitiveness in areas like AI. Critics worry about market distortion, but Goldman notes that these investments have outperformed the S&P 500 so far. Unlike emergency bailouts, example Chrysler, GM, these are strategic moves for national security and large-scale tech projects. Public-private partnerships can be effective for large-scale innovation, but picking winners and losers is debated as a political talking point rather than a market crisis. Overall, housing affordability remains constrained by supply issues, while government stakes in tech aim to bolster U.S. competitiveness, though they carry both political and financial debate. This section focuses on the AI bubble, circular funding, and key economic indicators. AI bubble concerns. AI stocks dominate the market. Nvidia alone makes up 8% of the S&P 500, meaning most Americans with 401ks are exposed. Goldman acknowledges that an AI bubble likely exists, but he sees no imminent crash, unlike the dot-com bust. Money backing AI investments is considered legitimate, not speculative smoke and mirrors, and some startups could become the next big tech giants. Circular funding deals. Many AI companies, chip makers, cloud providers, application builders, are invested in each other, spreading risk but also creating shared exposure to potential failures. These arrangements exist because AI infrastructure demand is massive, and exclusivity isn't feasible for competitiveness. Economic indicators to watch. Jobs and inflation reports are key to understanding the economy's strength. Due to government shutdown delays, recent data is limited, but upcoming reports will clarify employment trends and price stability. Overall, the AI market is in a speculative phase with interconnected investments, but widespread exposure is backed by real assets, and economic health will depend on jobs and inflation data in the coming months.